nearly $16,000. That's the gap on the same 50 grand in the same shares over the same 10 years between doing one thing with the loan behind those shares and not. Same money, same market, same risk. The only thing that changes is a tax label on a loan. It's called debt recycling, one of the most powerful mechanics in Australian personal finance, and one of the easiest to botch. So today, how it actually works, what it's genuinely worth at your tax bracket, and the 3 ways people wreck it. Both halves matter. First, the important bit. This is general information, not financial or tax advice. I'm not licensed. It doesn't consider your personal situation. And debt recycling in particular is a strategy where the details of your loan, your income, and your discipline decide whether it's sensible at all. This one genuinely warrants professional advice, and I'll say that more than once. Now, meet Sarah. If you saw the offset versus shares video, welcome back. If not, one breath catches you up. 150 grand a year, a mortgage at 6.1%, and 50 grand spare, that full head-to-head is linked below. Say she's run that maths and landed on the shares side. Her call made. This video isn't about whether to buy the shares. It's about the fact that there are 2 different ways to buy the exact same shares, and one of them gets the tax office to chip in. Australia's tax system treats debt in 2 completely different ways, and everything today hangs on it. Interest on the loan that bought your home, not deductible, not a cent, ever. Interest on a loan that bought income-producing investments. Shares that pay dividends, a rental property, deductible against your income. And here's the subtle bit. The tax office doesn't care what the loan is secured against. It cares what the borrowed money bought. Same dollar of interest, and depending on purpose alone, one version costs Sarah the full dollar, and the other costs her, after the deduction at her bracket, about 61 cents. So here's what debt recycling actually is. 4 moves. 1. Instead of buying shares with her 50 grand, Sarah pays it into her home loan. Her non-deductible debt drops by $50,000. 2. She asks her lender to split the loan. Carve off a separate $50,000 subloan. Its own account, its own statement. 3. She redraws that 50 from the split, and it goes straight into her broker account. 4. She buys the same ETFs she was always going to buy. Look at what just happened. Total debt, unchanged. The shares, identical. But that $50,000 split, the borrowed money bought income-producing shares, so its interest is now deductible. She's recycled 50 grand of dead home loan debt into working investment debt, without borrowing an extra dollar. Numbers. The split runs at 6.1%, so it charges about $3,050 of interest a year. Interest she'd effectively have been paying anyway on that slice of her debt. But now it's deductible against her salary. At her 39% bracket, that's about $1,200 a year. Back every year, for owning shares she'd already decided to own. Nothing about the market improved. The shares don't know anything happened. Only the paperwork changed. Let's run the decade. 10 years, shares at their long-run average, every figure after tax at Sarah's bracket. Option 1, the 50 grand just sits in her offset, the account that rides against your loan, so whatever's in it pays no interest. A tax-free saving at 6.1, $90,400. Option 2, plain shares after the capital gains tax bill at the end, $97,000. And the recycled version, same shares, plus that $1,200 refund banked into the offset every year, compounding tax-free. $112,700, nearly 16 grand, clear of the identical shares, bought the ordinary way. Same market, same risk. The gap is pure tax mechanics, which is why it's worth understanding, even if you never use it. Now spin the tax bracket, because that refund is simply your marginal rate applied to the same interest bill. So the higher your bracket, the bigger the check. 32%, about $1,000 a year, 13 grand over the decade. Sarah's 39%, 1,200, nearly 16. 47%, 1,400 plus a year, call it 19 grand. And here's the twist. At the top bracket, the plain offset versus shares race is essentially a dead heat. After tax, shares scrape ahead by barely 1/5%. Run it recycled, and it's 110,000 against 90. The tie evaporates. A high tax rate is exactly what makes a tax-free offset shine, and exactly what makes recycling sing. Same force, pointing both ways. Quick one, because you may have heard about it. There's a tax change proposed to start July 2027. It would scrap the 50% capital gains discount and tax share profits harder. Does it break this? Short answer, on what's actually in the bill. No. That proposal is about how capital gains are taxed when you sell. The interest deduction lives on the income side of the return. Different rule entirely. Run our pessimistic 2027 illustration, and the recycled pile drops to about 109.5. Still miles clear. The part of this strategy the 2027 proposal touches is the part it shares with any share purchase. The recycling edge itself, untouched. As ever, proposal, not law, details pending. Now the catches. And I mean it when I say this chapter is the reason this strategy is advisor territory. Rec number 1, mixing. The split's deductibility rests entirely on every borrowed dollar tracing cleanly to the investment. Redraw 50 grand and send even 500 of it to the family holiday. Or park it in your everyday account just for a week on the way to the broker. And you've contaminated the purpose. The ATO doesn't round in your favor. The account becomes a blended mess where every future interest dollar needs apportioning. The discipline is brutally simple. The split talks to the broker and to nobody else. One account, one purpose, forever. People wreck this with one lazy transfer. Rec number 2, paying for the privilege. Some lenders will happily split your loan and quietly price the investment split 0.25% higher. Does that kill it? On Sarah's numbers, no. At plus 0.25, the 10-year benefit drops from about 15.7 to 14.7. $1,000 haircut, not a knockout. But it's a real cost, and stacked with a split fee and your time, it's exactly the kind of thing to have priced before you commit, not discover after. The strategy survives a small rate premium, but only ask first survives it comfortably. Banks answer questions you actually ask. Rec number 3, the big one, doing it for the deduction. Every dollar of that refund exists because Sarah is paying $1 of interest on money she's chosen to keep invested in a market that can fall. If the shares decision is right for her, made calmly, on bracket and horizon, and sleep at night. Recycling just makes the same decision cheaper. But borrowing to invest because the deduction feels clever when you'd otherwise have wanted the certainty of the offset. That's the tail wagging the dog. And a 40% drawdown doesn't care how elegant your loan structure is. A deduction is a discount on a decision. It is never a reason for one. So, pulling it together. Factors, not instructions. The maths favours recycling when the shares decision is already genuinely made. When the bracket is high, because the refund scales with it. When the loan can be split cleanly and cheaply. And when there's steady income for the deduction to work against. It favours leaving it alone when the money might be needed soon, when the structure can't be kept surgically clean, when the horizon is short, or when the honest answer to offset versus shares was the offset all along. And the order is everything. Investment decision first, tax structure second. Get those backwards, and the cleverness is the problem. For whether any of this fits your loan, your income, your year, that's precisely the conversation to have with a licensed advisor and a tax agent. This is the strategy they exist for. The honest verdict. Debt recycling didn't beat the market. Nothing here did. It beat a tax label. Same 50 grand, same ETFs, same decade of ups and downs, and at Sarah's bracket, about $16,000 more at the price of one loan split. One iron rule about purpose, and the discipline to have made the investment decision first. Powerful mechanic. Unforgiving plumbing. Now you know both halves. There's a free calculator in the description. It runs the recycled line too, for your rate, your bracket, and your timeline. A learning tool, not advice. And if you want Aussie money decisions with the actual maths instead of vibes, subscribe. There's a whole series working through them, one honest number at a time. I'll see you in the next one.